Right. Lesson 6, investment risk. And the weightage for the exam on this topic is 11%. So let us first understand what is investment and what is investment risk. Investment in this context is defined as is a decision to forego the use of current resources in the belief that they can instead be used to create future benefits which are greater than their current value. So when you do investments, what happens is you are sacrificing your consumption, right? You are sacrificing your current consumption and you allocate part of your wealth into investments expecting future returns. So there what happens is you have an expectation that the future benefit of allocating that funds today is greater than what their current value is. That means you can grow it. You are growing it to a higher value than what it is today. That is the idea, right? So what is the risk in that case? Investment risk. Risk is that you have an expectation to grow these values, this amount into a greater or higher values. And when you are unable to materialize those expectations, it becomes a risk, right? That means you will not get what you expect, what you plan to derive. So that is a risk. In other words, your actual return being lower than what you anticipate. So there are a couple of concepts we need to study when we deal with this topic. Okay? These concepts, some of these concepts are very much familiar to us, but just need to understand the meaning of it. Inflation. So inflation is an overall general upward price movement of goods and services. Now, sometimes people try to define inflation as increase in price of several items. Just because the prices of several items go up, you don't call it an inflation. Inflation is not an isolated scenario. Inflation is a general overall market phenomenon, right? So, right, it's an overall increase, overall upward movement in price. Yes, that is what we consider as inflation. Right? That's why this inflation is generally measured using indices, right? Price indices, overall increase in the movement of price indices, not individual price increases in assets, right? Then we have a concept called nominal return. Nominal return. That is when a return or the interest is defined for a particular instrument or an asset. What is quoted? Let's say you are investing in a bond and it says you are entitled for a 10% interest. That 10% is the nominal interest that they are quoting. This is not adjusted for inflation, right? That is inclusive of inflation. You are saying you are getting 10%. So once you get the 10% interest, if there's inflation, your actual benefit of that interest will come down. That is called the real return. Right? Real return is the actual value or the benefit you are getting from an investment that is adjusted for inflation, right? That is adjusted for inflation. So when you have nominal minus inflation is real, right? When I say minus, conceptually, that is the idea. Conceptually, you are eliminating the inflation from nominal return to get the real return, but mathematically, when you do the calculations, it is not a minus per se, right? There is a formula or calculation that works. As you can see here, 1 plus real return into 1 plus inflation rate, right? 1 plus real return into 1 plus inflation rate is equal to 1 plus nominal rate. So for you to get the nominal rate, you have to deduct 1 from the answer. And it works other way around as well. 1 plus nominal rate divided by 1 plus inflation rate, you get 1 plus real rate, right? So if you can work out something little later. Then there's something called total return, right? Total return is when you invest some money in an instrument, you try to understand all forms of return you are deriving from that investment, all forms of return, right? Not just one. Let's say this is mostly relevant for, let's say, share capital. If you have invested in shares, you have the dividend income and you also have capital gain, right? You have capital gain. So when you sell the shares at a higher price than what you bought it, there is a capital gain. So you add the capital gain and interest together, the total return you compare against the initial investment and get a return as a percentage. That is called the total return. Now let me just give you an example right before I get into the next slide. I'll give you that. There's another one called holding period return. We call it HPR, holding period. So what happens with holding period return is sometimes you see, if you invest in an instrument and if you are the holder of that instrument until the maturity, you are getting the total return for the entire tenure of that instrument. Let's say you have invested in a 5-year bond and then you keep it for the 5-year period. So you get the total benefit of that investment over the 5-year period. But there can be situations where you invest in the bond in the middle. That means you can buy or purchase that bond from the secondary market in the middle. So when you purchase the 5-year bond, 2 years have already gone. So you have invested in the 3rd year. Then you have 3 more years to go. So your return start from that 3rd year beginning until the maturity. Sometimes you can even sell it before the maturity. You purchase it at the 3rd year beginning and then you sell it at the 4th year end. So whatever the period you hold it. So holding period return is the return you are going to derive from that investment within that period you hold that investment, right? During the period you hold it. So if you keep the investment from the beginning to the end, your holding period return is equal to the total return of that investment because you are keeping it for the total period. But if you do not keep it for the total period, whatever the period within which you keep that investment and the return you get is called the holding period return, HPR. Here is an example. Can we find out what the inflation is? You can use your calculator, mobile phone, or whatever, right? What's the inflation in this example? Can I quickly get it? Can someone do this? I get different answers. Some says 5.5, some says 4.5. What's the correct answer? Any further answers? I get two answers now. What's the correct one? So I get two answers, 5.5 and 4.5. That's the correct answer. Can we have a few more answers so that we can get it? So what's the formula? It is not nominal rate minus real rate. That's the formula we discussed. 1 plus real rate into 1 plus inflation rate equal 1 plus nominal rate. Right? Now we want to figure out inflation. That means this part. So 1 plus inflation rate equals 1 plus nominal rate divided by 1 plus real rate. Right? So how do we solve this now? 1 plus nominal rate 1.155 divided by 1.1. What's the answer you get? You get 1.05. 1.05 means you have to deduct 1, that is 0.5 as a percentage, 5%. Answer is 5%. That's why I told you earlier also, it is not nominal rate minus real rate, right? This is the formula. Don't forget it. Right? Answer is 5. It's 5% inflation. Any questions? Any questions? Right, let's move. Then we also need to understand how time value works, right? Compound interest and time value. So what is time value, by the way? What do you mean by time value? How do you explain time value? What is the advantage point? What do you understand with time value? Any idea? Time value? What is time value? No one? There's a value in time, which means money tomorrow is more valuable or less valuable than today. What does it say? Money tomorrow is more valuable or less valuable. If you are given an option to get, uh, let's say, $1,000 today versus $1,000 1 year's time, you would obviously prefer $1,000 today, not 1 year's time, right? The question is, why do you prefer $1,000 today than $1,000 1 year's time? What is the reason? That's what I'm asking. In terms of time value. Sorry, there was an interruption to the connection. Sorry about it. Right. So we were talking about time value. So one of the answers given was the purchasing power going down. But that is what we all generally consider as time value, but that is not the reason. Time value is not about inflation. There is an impact on inflation over time, but the concept of time value is not about inflation. So don't mix the two, right? Inflation also has an impact, but irrespective of inflation, there is a time value effect. So the time value is the ability of earning more when you have money early. That means you can grow money to a higher value in future than what it is today. So if you get $1,000 today, even if the inflation is zero, right? Let's say if the inflation is zero, $1,000 today will have the same purchasing power in $1,000 1 year's time. There's no impact on the purchasing power, but you will still prefer to get $1,000 today, because when you have it today, you have the ability to invest it and grow it to a value greater than $1,000. That is the value of time, right? Time value is about that ability, the ability to grow your money to a higher value than today. So when the inflation comes in, there is a further dilution. Right. Now, this particular formula explain how we bring in that into account. So there is another component here. You can see time value of money, and the other thing is compound interest. I think most of people here are aware about compound interest. But the interest, you have two components: simple interest and compound interest. Simple interest is where you get a return to your capital, right? If you invest 1,000 and if the interest rate is 10% and you keep it for 2 years, you get 1,000 into 10% for 2 years. That is 200 is your return. First year 10%, 100. Second year 10%, 100. That is simple interest. But the compound interest is when you are able to earn interest on interest, right? Compound interest is there. So the simple interest, you can earn interest only on capital. Compound interest, you can earn interest on interest as well. So for the second year, in the previous example, you can not only earn interest on the 1,000 capital, but also another 10% on the previous 100 you have earned, right? Therefore, the second year earnings is more than the first year because you have interest on interest earned on the previous year. So that's compounding. Compounding is keep on adding the interest. So when you use compounding interest, that is how the banks and all the financial institutions calculate interest for their investment. You use those techniques to figure out the future value and present value. So PV stands for the present value. 1 plus R. R is the nominal interest rate. N is the period, right? Rate, period. How many years? So the present value multiplied by 1 plus R to the power N gives you the future value. If you deposit 10,000 today at 10% for 5 years, you can replace the numbers and see how much you can withdraw in 5 years time. And you don't have to do a separate formula. The same formula you can rearrange to get the present value, right? If future value equals present value into this factor, right? Future value equals present value multiplied by this whole thing. Then if you rearrange, present value equals future value divided by this whole thing, right? We are just rearranging the components of the formula to suit the requirement, right? It's not a new formula, the same formula rearranged. So with this, you can figure out the present value and future value of your investments or any amount depending on the period you want to look at. Right. And there is another component that is very important for us. We need to understand that component as well. So I think this part is clear to all of us. The other component, before I get into that, let me explain the function. Let's take an example. Let's say I can earn 10% interest on 1,000. So at the end of the first year, if it is 1 year, I get 1,100 because 1,000 into 10% 100, 1,100 is what I'm going to get at the end of the year. But sometimes there are options. The bank or the institution will say, we calculate interest every 6 months. Sometimes it could be every quarter. Sometimes it could be every month. So more than once a year. So let's say in this case, if it is biannual interest calculation, you will get 1,000 into 10% into 1/2 for the first 6 months. That is 50. For the second 6 months, you have 1,050 into 10% into 1/2. How much? 52.5. So if I look at the total return, in this case, I have 50 for the first 6 months, 52.5 for the second 6 months. So my total return is 1,102.5. Right, 1,102.5. So if I look at the return, right, in the previous case, our return is 100 over 1,000 investment. That is 10%. Same thing I am getting. In this case, I am getting 102.5 over 1,000. So here the ratio is 10.25. Now you see, although they quote 10% as the interest, because they pay interest twice a year, I end up earning 10.25 effectively for that investment. So my actual interest or actual return from this is not 10%, actual return is 10.25. Now this is called the effective rate. So in other words, when I have biannual or monthly or whatever the case may be, instead of paying biannual interest, if the bank was to pay me annual interest for the same benefit, what would be that rate? That is the effective rate. So effectively, I am earning 10.25. Now, this particular answer we have got by calculating the numbers. You can get it straight away by solving a formula that is called the EIR, effective interest rate formula. 1 plus R divided by M to the power N right? Minus 1, right? So that's what you get here. I'll show straight away the formula here. Right? 1 plus r divided by m to the power m minus 1. So m is the compounding frequency, right? M is a compounding frequency. If compounding happens twice a year or biannual, you use 2 instead of m. If compounding happens quarterly, you use 4 instead of m here. If it is monthly, you use 12. So if I take the previous example, right? If I take the previous example, r divided by m to the power m minus 1. So 1 plus 10% divided by 2 to the power 2 minus 1. That is 1.05 to the power 2 minus 1. You can calculate it. You can calculate. Use your calculator and see what you get. 1.05 to the power 2. So in other words, you multiply 1.05 by 1.05, same thing is there. Right? What do you get? 1.1025. Then minus 1 means you take this one off. 0.1025 as a percentage, 10.25%. You can see without mathematically calculating the answer, you can straight away get the effective rate, right? Effective interest rate. We also call this annual effective rate, right? So there are different terms like this, but it gives the same thing. So it is an important concept we all need to know, because sometimes these financial institutions, I think most of you are in these financial institutions, but sometimes these financial institutions publish misleading information to the customers or public, showcasing a unrealistic or too good to believe offers. Say, for example, even recently I saw some organization has done something wrong, where they were promoting some product. Sometimes people do like this, right? I'll show you an example. You can invest 1,000 5 years with us. You can get 500, and 500 divided by 1,000 is 50%, right? They say you can get a 50% return. Yes, mathematically it's right, right? That is 10% simple interest. If you forget about compound interest, it's simple interest, right? Simple interest, 5 years at 10%, you get 500. And then you say 50% return. So the general public get caught with this kind of presentations. It has been happening in the past big time by financial institutions. They publish in papers like this. Mathematically, you showcase something very attractive, but poor customers do not know the science behind it, right? So then the central bank came up with this regulation. Whenever you publish a financial product, it is a must that you disclose the effective rate, like the tag on the cigarette pack, right? This is a regulatory requirement. Whenever financial institutions publish their financial products, you must mention the annual effective rate somewhere. So here the effective rate is 10%. Simply got, if you take, right, it's not 50%. So therefore, it's very important for us to understand whenever there is a financial product, always try to calculate the effective rate and figure out. And this is also important when you compare several options. Let's say you have some money, you have three options: bank A, bank B, and a finance company has given you three different options. One is saying we'll give you 10% annual interest, another one will say I will give you 9.75, right, monthly interest calculation, right? Another one might say, okay, I'll give you 9.5, right, quarterly, something like that. So by the look of it, it's difficult, right? By the look of it, this seems good, but this is monthly interest. You know, monthly interest calculation, definitely your effective rate is higher than this rate. Quarterly, this one, definitely it is higher than this rate. So it's difficult to compare unless we calculate. So best thing is to convert. So this is annual. So AER is also 10%, no issue. You can convert this into AER. What is the annual effective rate here? What is the annual effective rate here? So when you have annual effective rate, it makes your life easy when you compare the options. You go for the option that gives you the highest effective rate. Very easy. Therefore, when you make financial decisions, it's very important to understand this concept. But unfortunately, most of our people, I sometimes find even top executives, right, educated people, they don't get it. They sometimes get caught with some of these promotional schemes by finance companies and various institutions because they fail to realize this effective rate concept. Right. Any questions, clarifications up to this point? Good. No questions? All okay. So the time is 9:30. So we'll stop at this. So we will continue from this point. So we are going to meet on the Boxing Day. I'm not sure about the classes. I think the classes will be there. Just check with the office. They will clarify whether the class is there or not, because Christmas is coming up. If we don't have, then probably unless we go for another date, it will be the next year. We'll see. In any case, right? In any case, let me wish all of you a Merry Christmas. And if you don't meet again before the next year, Happy New Year too. There's a question. 5-year EIR. There's no something called 5-year EIR. EIR is calculated for 1 year, right? So when you calculate EIR, that is the effective annual rate. So whatever sometimes when you have bonds, right? When you have bonds, the calculation is little complicated because you have to take the maturity value, then you have a capital gain part as well. Then you calculate a effective rate taking both into account, but again you are calculating the annual effective rate. So we don't go to that level of calculations here. Probably maybe we can offline look at it if you want. That EIR calculation for bonds and various financial instruments. I know sometimes when you want to amortize, the regulations or accounting standards say use EIR method, right? So then you have to get it averaged using the time value concept. You have to put it. And in fact, there are, if you can easily do it if you go to Excel, there are Excel functional keys. Right? There's an EIR function in Excel. You just replace the numbers, it will calculate for you. Right? We'll see you the next day, whatever the date the office will declare. And good night.